There's less issuance in the summer, inevitably. The liquidity is that much thinner. I think they're getting a little concerned about the extent to which bunds have spiked over the last couple of months, and I guess you could interpret this as a coded message to support bunds, try and get yields down. The QE trade essentially back on again.
Yeah, that was a dramatic move. I mean, if you operate and operated in terms of decimals, you know, on a volume desk, you could have made a bundle, right, with this volatility.
Yeah, 10 basis points.
You've seen in bunds, that's 1,000% change in the yield. Now, 0.6 of a percentage point. Where do they go from here, though? Is it priced right for the current environment and, you know, the QE program in Europe? Or?
Look, I mean, they got down to nonsensical levels a couple of months back, didn't they?
Did you know they were nonsensical then?
Well, at 4.7 intraday basis points, yes.
Then why weren't people pouncing on it back then? I'm just kind of curious.
There's a very interesting question. Basically, I think it has to do with your outlook. And those have seemed to have gone into two camps. There was the QE trade, where they thought the ECB would continue to push down yields. And then increasingly, we've had the so-called reflation trade coming through. And that's seen some slightly better than expected economic numbers from the Eurozone. We've seen the expectation that Greece may not default, and that's had a little bit more enthusiasm in pushing up yields to slightly more normal levels.
Yeah. You know, something just occurred to me, just jumped into my mind. We need to give credit to him because he's been sort of raked over the coals ever since he left PIMCO. But remember Bill Gross?
Sure.
I could swear it was Bill Gross who a couple months ago said the short of the century is German bunds. Spot on, right?
Maybe he was the catalyst. Maybe his influence was the catalyst.
What folks at Janus are doing out there. Okay, so aside from bunds, I mean, there's still a huge differential between, you know, the same tenor in U.S. Treasuries and bunds and JGBs. I mean, we had a positive print today, a slight bit of good news out of Japan. Was that an overwhelming catalyst for action in the JGB market?
No, I don't think it's going to have a material effect. However, it is positive. Obviously, from a growth perspective, these numbers were well above expectations.
Yeah.
Growth was evenly balanced between consumption, investment, and net export. So it's a good story for Japan. We remain overweight Japan from an equity perspective. I think it's one of our top picks for investors in terms of asset allocation.
Right.
Bond-wise, in the US-wise, there's a little more uncertainty, I think. There's a bit of a debate at the moment about the actual momentum in the US economy, particularly in the first quarter leading into the second quarter. The most closely watched Atlantic Fed GDP Now model is suggesting growth being substantially lower than consensus forecast. They were right on the nail in the first quarter when they got around 0.2, 0.3%. They're currently suggesting that second quarter growth is around 0.7%, which puts them at very substantial odds with consensus.
Right. So what is the strategy in the U.S. markets right now? I mean, we talk about the 10-year Treasury because we're limited in terms of how many different instruments we can go through. I haven't talked about the U.S. zero coupon strips for ages. Right now,
coming back,
where you get massive leverage. Of course.
Well, look, I mean, I think from my perspective, one of the quarter or the year to date has seen the most extraordinary amount of dollar issuance, almost $500 billion year to date in the United States. So, notwithstanding this move higher in yields, there's clearly a huge amount of demand for credit. Frankly, we're seeing it here in Asia as well. Year to date, this has been one of the biggest years we've seen for many, many years. There's still a huge amount of demand for the sorts of issues being launched by Chinese issuers, Hong Kong issuers, etc. So notwithstanding these higher yields and the impact on existing bond prices, nevertheless, we're seeing a lot of investor demand.